Welcome back to the Wall Street Podcast. Today, we're doing a deep dive into a really interesting report. It's titled, What Would It Take to Clear China's Housing Inventory? Number 3. Forming a positive feedback loop is the key. This came out from Goldman Sachs, China Securities Company Limited, on August 21st, 2025. And essentially, it looks at historical data, current trends, and tries to figure out solutions for China's housing market issues, the deflationary pressure, weak demand. The core idea is how to create a positive feedback loop. It covers supply, funding, demand, and what it all means for developers.
Yes, and what's quite striking is how it uses history, specifically Shanghai, between 1998 and 2003. Back then, after the housing reforms in the late 90s, China had this huge oversupply. We're talking 500 million square meters completed, but maybe 200 million unsold nationwide by 98. Shanghai was similar, but, targeted stimulus, like a big income tax rebate, RMB 9 to 16 billion over 5 years, it actually worked. It absorbed the excess supply. So this policy push created that positive loop. Average selling prices started growing again, land sales picked up, and property investment, well, it added about 9% to GDP growth. It really shows that direct, focused intervention can work. The payoff was bigger than the cost.
That's a fascinating precedent. So applying that logic to today, the report sees quite a bit of headroom, right, in Tier 1 and Tier 2 cities. Something like 3.5 billion square meters of potential new housing, which is, 14 times the projected new starts for 2025 in those cities alone. That translates into a huge potential for construction investment, fixed asset investment, or FAI, maybe RMB 25 trillion.
Exactly. And the economists at Goldman Sachs ran some scenarios to stop the property sector from dragging down GDP, or maybe even get a slight positive contribution by 2026. Construction FAI needs to stop falling so fast. The decline needs to narrow to maybe -5% to 0%, or even grow slightly, 0% to +5%. Now, getting there means boosting new gross floor area starts by 90% to 130% compared to the base case. But importantly, even that big jump only uses about 20-30% of that total headroom you mentioned.
Okay, but building all that requires funding. How much liquidity are we talking about for developers?
Well, the report estimates developers would need an extra RMB 1.4 trillion to RMB 2.8 trillion in total. That's for the added construction and potential land buying in 2026. Though if demand stimulus works quickly and effectively, that need might drop to around RMB 1.1 trillion. So solutions involve boosting existing channels, like the whitelist projects, those are chief projects banks can lend to, and using local government special bonds. They also mention more creative ideas, maybe asset management companies partnering with developers, things like that.
Right. Funding is one side.
Right.
But you need buyers. The report stresses stimulating demand. Otherwise, inventory could just pile up, couldn't it? Like 30, 40 months worth in Tier 1 and Tier 2 cities by the end of 2026 if sales don't pick up.
Precisely. To avoid that, you'd need to sell an additional 210 million to 310 million square meters of GFA in 2026 alone. But the hurdles are real. Affordability is a big one, especially in Tier 1 cities. The price-to-income ratio is around 20x, much higher than global peers. And that hits non-hukou households, those without local residency permits, particularly hard. Plus, the overall housing supply ratio is low, about 0.7x.
So how do you bridge that affordability gap? What does the report suggest there?
It points towards home purchase subsidies. The range is quite wide, depending on how you calculate it, maybe RMB 0.2 trillion to 0.6 trillion based on price gaps, or possibly RMB 0.6 trillion to 1.0 trillion if you benchmark against global affordability ratios. Alongside subsidies, they suggest easing mortgage rules and, importantly, removing home purchase restrictions, especially in those Tier 1 cities. The goal is to boost sales volume nationwide by maybe 25% to 7%. And interestingly, the report notes that households theoretically have room for over RMB 50 trillion more in mortgages. So household leverage itself might not be the biggest obstacle.
Okay, that makes sense. And what's the read-through for the developers themselves? It sounds like liquidity helps, but maybe not equally.
That's right. The liquidity injections would mostly benefit developers who already have land banks in those higher tier cities. However, there's a potential downside, at least initially. If supply increases before demand really recovers strongly, it could pressure prices and margins. Competition would heat up. The report does highlight Longfor as a potential beneficiary, given its footprint in Tier 12 cities and its focus on deleveraging.
So putting it all together, it sounds like success hinges on a kind of coordinated effort, doesn't it? Learning from the past, intervening on both supply funding and demand affordability.
Absolutely. It's about orchestrating these pieces to hopefully trigger that positive feedback loop and restore confidence.
And for you, our listeners, this isn't just abstract economics. If you're thinking about buying a home in China, these potential subsidies and eased rules could make a real difference, especially in major cities. More broadly, if construction picks up, that means jobs in manufacturing, materials, and so on. It could boost local economies.
That positive loop, if achieved, could stabilize the wider market and improve general economic sentiment.
So a final thought to leave you with. Consider how China is trying to use its own history and significant policy levers to manage this property cycle. Could this approach offer lessons or perhaps warnings for other countries facing similar housing challenges? And what might be the longer-term ripple effects globally if China does manage to successfully restart this positive feedback loop in its property sector?